Welcome to 10 Minutes About from Global Risk Management. Today we are talking about oil market drivers. Here in the studio with me I have our chief analyst, Arne Lohmann Rasmussen.
Thank you, Lisa.
So Arne, what's the most important theme for the commodity market right now?
I think it is the Chinese reopening. That is really the number one theme. It will have a profound effect on metals, but also on energy markets. I actually brought with me a small chart. It shows the sort of expectations of how much oil demand will we see in 2023. And as you can see, it's picking up roughly around 2 million barrels a day, and the global oil market is currently around 100 million barrels. So it's 2% or 2 million barrels a day. That's actually quite a lot. It's what Norway produces basically, and half of that growth will, in our view, come from China. So China is important here. We just recently saw, for example, the Department of Energy in the US revising up their forecast for Chinese demand. We're seeing the number of scheduled flights, for example, both globally but also in China, is picking up because people want to travel. We see congestion numbers in China be very high. They are some 60% above the level in 2019. So people are going to their car. They're driving around in China, and we actually see that there's less congestion in trains, metro, and so on. So I guess a lot of people are actually using the car instead of going by public transport. Probably they are a bit afraid of being infected. So, but it boosts oil demand. So China is important, and it is a theme that we follow very closely. And I think it is a theme that will tend to push prices higher going through 2023.
And how does the Russian sanctions come into play with this?
Yeah, the Russian sanctions is of course also important, but I think they are actually been downplayed a little recently, because it seems like Russia has actually managed to get their crude oil and to a certain degree also their products, diesel, gas oil, jet fuel, and so on, onto the market. But if we take the sanction, remember in December we had the crude sanction, where it's illegal for Russia to export crude to Europe, and they had to and you had to go with this price cap of $60 if you want to travel. Carry Russian oil on European vessels. And then here, February 5th, the product sanction came into play. And I think it's fair to say that the Russian crude oil is finding its way to the global oil market. Remember, the oil market is a global market. So basically what happens is that India, Russia, to a certain degree Africa, is buying the Russian crude, and then they're not buying the Middle East crude, which is then shipped to Europe. So I would say that the crude oil market is well supplied. We also see in the US that inventories are rising quite significantly. The product market is probably a bit different. There was a lot of fears that we have a very tight gas oil / diesel market after the sanctions, the product sanction came into play. But it turned out that Europe was actually well supplied. There's been a lot of pickup in import ahead of the sanction day. So I think there's a bit of inventory that needs to be worked off, so to speak, the next couple of months. But I'm still a bit concerned that the product market is a bit more sophisticated or complicated. So I'm a bit afraid that we will see higher prices, higher spreads when we look forward. But for now, the market is probably well supplied. But Lisa, as working in sales, are the clients concerned about these Chinese reopening, Russian sanctions, very expensive gas oil, diesel last year? How do they see it?
We still see an eager to hedge. It's now shorter tenor than it used to be, but clients they're a bit concerned on how the market's gonna develop in the future, both because of the Chinese reopening and the Russian sanctions. So in general, we do see a big demand from our clients to do hedging.
Yeah, but I think that they prefer these shorter hedges.
Yes.
But also reflect that the uncertainty is high at the moment, because on the other side we also have US rates maybe hitting 6%, also in Europe, and that would put a damper on the global economy. And if the global economy goes into a significant slowdown or even recession, prices will come down. And then I think it's sort of prudent hedging policy to have relatively shorter tenors, not to be caught in a global recession.
You often talk about that 2023 is going to be a year cut in two halves. Can you elaborate a bit on this?
Yeah, I think the first half year is basically now, as I mentioned, that for example, US inventories, also inventories in ARA in Amsterdam are well supplied. They're huge inventory built in the US. There's actually an overproduction of crude oil at the moment. Product stocks have been sort of filled ahead of the Russian sanction coming into to play. China is not really up and running in respect of demand. So for now, there's a sort of a downward pressure on prices. There's a build in inventories. That's actually what you can see on the chart I have brought with me. So when the green bars are above zero, we're building inventories, and we're doing that in this quarter and probably also the next quarter. But in the second half of the year, I actually believe that things will reverse. Production will probably stay more or less unchanged. Maybe Russia will have a hard time actually producing. They will lack technology. They might have a harder time getting their crude shipped and so on. So Russian production will stay muted. OPEC production will stay muted, but demand will continue to pick up both in the OECD area, but especially in China. And then we will see this inventory draw in the second half of the year. And I think that could actually open for prices moving towards maybe $100 if we talk about Brent oil prices. This is of course about crude oil, but I think the story is quite similar in many of the products in the bunker market and so on, that we have abundant stocks now, inventories now, but it will change in the second half of the year.
Earlier you spoke about the higher rates. Can we go a bit more in depth of this? Aren't you afraid that the higher rates going to erode demand?
That's definitely sort of a risk factor, a factor that could push prices down. It all comes down to whether especially the Fed, but also the ECB will manage to sort of manage a soft landing where the economy slowly slows down, unemployment maybe rise a little, but you still have some growth, but you do not have a full stop of activity. You do not have a recession. If they can manage this soft landing, I think my sort of scenario with a tighter inventory in the second half will play out. But if they misread the economy, if they actually are tightening too much, or if they are forced to tighten too much because inflation is still very high, both in the US and Europe, it can be that whether they like it or not, they will have to sort of create a recession to get inflation under control. And in that scenario, prices will probably be lower than the prices we have today. So the level of interest rate is definitely the number one risk for oil prices on the downside.
Before we finish for today, I have one last question for you. Do you think we're gonna hit the $100 for Brent again?
I think if the Fed manage to create this sort of soft landing, we will. But there's definitely also a probability that we will go towards $60-70 for Brent if they do not manage this soft landing.
Thank you very much for coming to the studio today, Arne.
You're welcome.
That was today from GRM on 10 minutes about the oil market drivers.